Thanks everybody for joining us today for this webinar. The topic is understanding key actuarial concepts. And the actuarial issues are really key for pools. Pools are not immune from financial challenges, and those financial challenges generally are going to be actuarially related. And the subject today, we're going to really focus on the concepts, what actuaries do, what work are we doing for pools, why are we doing that, but not so much the how we're doing. You don't need to know that as a board member or as an executive director. It's more important what we're doing and why we're doing it. So again, we're not here to teach actuarial calculations. More important to understand why this actuarial input is needed for the success of your pool. Now, in preparing this, worked very, very closely with AGRIP, and we really wanted kind of a session, a webinar that was geared towards perhaps a first-time board member. But that said, there's also going to be probably something that can be learned from the old-time board member, or even in an executive director, because I think we probably will challenge a little bit of some of the conventional wisdom, and I think challenging that's always good. So there's going to be three main areas we'll talk about. One is, like the topic, what are the key areas actuaries help with? What are those concepts that we're dealing with? It's good to have a grounding in that if you're going to be, either running a pool or overseeing a pool as a board member. And then kind of from our perspective, from the actuarial perspective, what are the common issues that we see out there in pools dealing with actuaries? And then finally, again, from the perspective of the actuary, what are some tips to kind of overcome those issues and kind of, making sure you're getting the most and the best information to make decisions on. So with that, we'll get right into it. Again, first topic, what are the key areas actuaries help pools with? And let's just start right off with the basic financial transaction that's happening in pooling. Okay, you got members, you have a pool. Now, the member pays money to the pool. They call it a contribution, maybe called a premium. And then what are they actually getting in return? Well, the pool is paying for covered claims. And that's all sounds simple enough, but you quickly get into kind of an accounting issue because there's a timing difference. You're paying money for the pool today, and the pool really initially is only giving you a promise. They're saying, hey, I promise to pay the covered claims, but they haven't actually paid the claims yet. And so this timing difference creates kind of something you have to account for in order to have meaningful financial statements. And this is how a very simplified balance sheet would look like. So again, assets minus liabilities equals net position. And so a pool has assets. They have, would have liabilities, and they have this net position. Well, the assets now, the pools collected this money from their members, and so their assets have increased, but not all the claims that they're responsible have been paid out. So on the liability side, they need to recognize, what is the cost for us to fulfill the promise. You need to, again, financially recognize the unpaid claims in order to have a valid perspective of what your financial situation is. You can't just count the assets and act like you don't have the liabilities. You have to kind of account for both. And then the largest liability on a pool or generally an insurer's balance sheet is going to be that unpaid claim. That unpaid claim, that is it's basically an accounting estimate, and that's coming from the actuary. The actuary is being asked, hey, how much is this pool going to pay out in the future in order to fulfill the obligations it has from collecting all that money and contributions? That's the basic question. And it's important, you can see it's very material to the financials, so it's very important you have a qualified person doing that's kind of trained and has that expertise, and also independent, because you want to make sure, and it's most pools I think are pretty good on this front right now. They most pools I would suspect are having actuaries help them with that number. Now, this concept is in this kind of structure of the financial statements, it's one of the challenges. I think it's really different than what a lot of the pool members are used to in their own are generally the pool members in their own personal life. So I'm just going to do kind of a side-by-side comparison of what maybe your personal net worth financial statement is, and how does that compare to the pool financial statement. So if you're going to put together your personal net worth, you would look at your assets, and people probably, okay, my biggest asset's my house. That's probably pretty standard. And I also have some, my 401k and my, savings accounts. And so that's my assets. Your liabilities are pretty straightforward. You're going to have, your biggest liability is going to be your mortgage. And that liability is very definitive. It says, here's a statement. This is how much I owe on my mortgage. Maybe you have some other credit card bills or maybe a car loan or something, but it's pretty definitive. Your liabilities are known. You have the net worth, just like you have the net position. The difference, though, with the personal net worth statement is your assets are the variable. What's your house worth? You don't really know until you sell it. And you would get maybe an estimate if you're trying to put that together. You can go look at Zillow, you can, get a formal appraisal. But even that is just it's in essence an estimate of what your asset is worth. You don't really know. And it's kind of reverse for a pool, right? Their assets are generally known with a fairly high degree of certainty. They have a certain amount of money invested. They may have a building. They may own their own kind of building, but that's going to be a small piece. And the unknown is the liabilities. And so it's kind of reversed. And that's, pool members may not be used to that concept. They don't have that unpaid claim liability. They've transferred that to the pool because they don't want that uncertainty on their balance sheet. And then furthermore, this number, just to illustrate how important it is, it really can shape your financial perspective of the pool. And so we have the same on the left, we have the same graph, or I showed you before, assets, liabilities, net position, with the biggest liability here being the unpaid claims right here. If the unpaid claims were presented at half that amount, what would happen? Your liabilities would go down and your net position would go up. And all of a sudden you would think you're a lot financially stronger than you were under this presentation. And the opposite, what if the actual liabilities or the estimated liabilities were double? Instead of 6 million, it's 12 million. Now the pool is insolvent. So it is a very impactful number. Your financial auditor, in all likelihood, is going to expect it to be done by an independent actuary. And that independent actuary is giving you that number, you book it, and now you have some meaningful financial statements to work with. Okay. Now, next topic, what are some of the concepts here that actuaries are dealing with? We're going to get a little technical, but I think it's important to kind of understand kind of what's going on, what are the challenges, the actually, in interpreting all the loss information. So the typical process here, so this example, we're going to say let's assume you have a December 31st, 2023 year end. The pool would send the actuary a complete loss run or a claim listing. And it's going to show really from pool inception, for every claim they've ever had, what's the loss date, what's the coverage, who's the claimant, what member is it from, and then it'll also have some loss amounts. It'll say, well, how much have we paid on this claim, as of this date? How much do we have set aside for maybe future payments on the open claims? So again, it's a very voluminous list. And then the actuaries, we're not really looking at individual claims. We're aggregating the claims and organizing the data so we can kind of identify various patterns. And we organize the losses according to the loss year in which the claims occur. And so what you're seeing on this chart on the left is, what are the loss levels, if you take all the claims that occurred in 2019, what's the value of all their losses as of this date? And so 2019 claims valued as of December 23, $9 million. And if the claims that occurred in 2023, they're valued at 4 million. And so this would be, you may have a similar report showing up in your loss run, but if you're just looking at this information on the left and without looking at anything else, it sure looks like a favorable trend. Your losses are way, way down compared to what the prior year losses are. But there's an issue here. We have to consider something called loss development. And so what you have in 2023, this is the claims that occurred in 2023, and this represents the payments you've made on those claims during 2023. What you have in 2022 is you have 2022 losses, you have the payments that were made on 2022 losses in 2022, and the residual payments you made on those claims, because they weren't all necessarily settled right away, in 2023. And so you have basically 2 years of payments on 2022 losses, 3 years of payments on 21, and so on. And so the actuary, we want to, basically compare apples to apples. So we want to we have this 2023 year, it's the same. But if we're going to really compare this to the prior years, we need to look at the prior years at the same point of, we would call it maturity or months of development. And so we would want to know, okay, what was the loss level for 2019 at the end of 2019? The 2020 losses at the end, what were they looking like at the end of 20? That's what you would want to be comparing the 23 year with. How does it look? That early indication of what the losses are. And you can see exactly very different observation here. Instead of a very favorable trend, it'll actually, if anything, it looks adverse. The 2023 losses, at least the initial look at those losses, is less, or is actually more than what the more recent years have been. And so that's the concept of loss development. You have to look at losses that way in order to have these valid perspectives of how things are actually trending. Some of the other concepts actuaries deal with is trend inflation. So what the line here represents, I just grabbed the national CPI index. But basically, if you're going to be looking at old losses to kind of help you predict what's going on currently, those old losses are in yesterday's dollars. And you need to kind of restate those losses in today's dollars. So you have to kind of make this inflation adjustment. And I think we all know that, right? The claim in the 90s, maybe they were selling for 100,000 or settling for 100,000, and now that same claim's worth 300,000. And it's just more your general inflation. Another consideration the actuary makes would be related to the pool size and maybe potential growth on the pool. So we have a measurement of pool size. Let's just say, for example, this is measuring the pool size by the payroll of all the members. And the payroll is kind of a proxy for the size. And in this example here, the pool, maybe they've added a few members in the last recent couple of years. And so their size has increased. That may be a reason why the losses levels in the recent years are going up. It's simply because they have more members. The actuary wants to normalize things for the size of the program. You can't just assume. You have to make an adjustment when you're looking at the past, trying to understand it. You have to kind of consider what is the growth rate going on. And then lastly over here would be another thing would be the pool retention. So the pool is responsible for the claim, but typically the pool buys something called reinsurance, and there's they call it a self-insured retention, and you can kind of think of it like a deductible. And so in these older years, 2019 through 21, under this example, the pool had $100,000 retention, meaning they were responsible for the first $100,000 of losses. But in recent years, they were forced to increase that 100,000 retention or deductible up to 250,000. So if they're responsible for the first 250,000, that would suggest that maybe the losses in these years are going to be higher simply because the pool is retaining more of the loss and isn't transferring as much of the loss off to the reinsurers. So a lot of the actual work is really controlling for these things. You have this concept of loss development. We have to consider inflation. We have to consider the size of the program. and we have to consider the pooled retention. All these things are going into calculations, ultimately trying to get at, what is the, total cost of claims historically, and then the difference between that and what you've paid would be that unpaid, then that feeds into your financials. On that topic then of the unpaid claim liability, just kind of let's talk about some of the misconceptions here. Okay. Fact or fiction, that there's a lot of people think the actuary actually knows what the actual claim liability will be. We don't know. I mean, we are giving you an estimate. And that's why it's called an estimate, is because we don't know. And so you can kind of think of it like a weather report. And, the weather person gives you a weather forecast. And I think the farther out that forecast, probably the less accurate it could be. And so when you're talking about estimating unpaid claims, you're literally talking about, for workers' comp, you're estimating, how much are you going to pay in the future, meaning the next several decades, to settle our current inventory of claims. And there's going to be some estimate variation in that. So the actuary actually doesn't know. You're actually booking an estimate, and the actual cost of claims, will be somewhat different than that estimate. Another misconception is, I think people get confused. There's the financial presentation, meaning how you account for things. And, does the financial presentation change the actual financial condition of the pool? And so one of the concepts here is, okay, that the actuary said these claims are going to be paid out in the future. Well, if they're going to be paid out in the future, maybe it would be more economically reality to present value that liability, because they would be called discounting, right? These claims on average are going to be paid out 3 years in the future. So we should be able to discount, 5% over 3 years, knock 15% off of that liability. And that's going to give us a better economic or more accurate economic picture. And then the other argument would be, well, that's an estimate. And an estimate is subject to volatility. We want to be conservative as a group. And so we want to not just kind of book that midpoint estimate. We want to maybe add a little bit of a margin on that estimate to be safe. And it's commonly would be called a confidence level. We book our liabilities at the 80% confidence level. The reality is, it doesn't really matter how you account for it. From a financial condition, it's cosmetic. You're changing numbers on a piece of paper called the balance sheet, but you still have the same assets, and you still have the same unknown liabilities. You can't just magically, you can make things maybe, appear a little better, put a little lipstick on it, so to speak, but you still have the same fundamentals here. You still have the same assets and the same unknown liabilities. And so I think pools get, a lot of discussion. Oh, should we discount? Should we not? It's not that the accounting isn't important, but it's not an impactful decision as far as really what's going on financially. And lastly, this one I think it's so tough for new board members. They come in and they hear certain terms, and some of the terminology that's commonly used is probably not the best. And it's coming from the insurance industry. And I was careful here. I kept calling it unpaid claims, the unpaid claim estimate. And it's commonly called reserving in the broader industry. And so you just heard the actuary, they came in, they gave a presentation, and the actuary is signing off that our reserves are adequate. And oh, wow, this is great. We got this professional. And you're thinking reserves means like a set aside, like, here's our rainy day fund. That's not what's happening. The actuary is saying, is giving you an estimate, and they're saying that estimate is reasonably stated. The actual reserves, meaning the adequacy of that net position to handle the volatility that's inherent in these estimates, that's a whole other level of discussion. So be careful with the word reserve. If you're hearing it, get clarity on what they're talking about. I think it's a lot better if if you recognize it's an accounting estimate. That doesn't, if I sign off an accounting estimate, you probably are gonna not get the same good feeling as if I say, hey, I just signed off on your reserves. So, and again, it's just the way it comes in from the insurance industry. They call it reserves. And so it's commonly gets called that in the pool, which can be problematic. for especially a non-insurance person. Okay, another area actuaries help out with is budgeting for next year's losses, right? So you're gonna, typically have a meeting in advance of a year. You have to decide, well, what do we need to collect from the members? And your typical pool budget would look something like this on the left. You have losses. That number is generally you're gonna get asked the actuary, can you look at our past patterns? Can you give us a projection of what our loss fund needs to be for the year we're trying to rate? You'd ask your broker and, okay, what's your best guess of what our reinsurance is gonna come in? You'd have, look at maybe your CFO, let's get our admin budget. And then on the very top, you often would maybe collect a little bit more to top it off and say, you know what, we're dealing with estimates. We probably need a little bit of a cushion, kind of depending on what your financial situation is. And that would be kind of the margin or a capital contribution. Well, how's the actuary getting to that loss fund? Well, it's basically, they've done the analysis of the historical losses. They've considered development, they've considered inflation, they've considered kind of the size of the pool. They've considered the self-insured retention level changes. And, in its simple terms, they're just looking at the historical losses, fitting a curve through that or a line and projecting out what the new losses are going to be. It's more of a midpoint projection. The actual losses could come in more or less, but that's the number that's feeding into generally your budgeting process. All right. Now, one of the we call it like a touch point with the members, is really ultimately what are they actually paying, right? And this is where you get into kind of the rating system. How do you actually calculate at the member level what they need to pay into the pool? So again, we have this financial transaction. You got a member, they're paying money to the pool. Well, the specific member should pay in accordance with the risk they're contributing to the pool. And so the rating system is all about trying to quantify the risk at the member level. And then what does the pool do? Well, the pool pays for covered claims. And if you have what we would call a fair rating system over time, and it could be a very extended period of time, the amount of money you're kind of paying in should roughly be in line with the amount of money you're taking out, or more or less. So I guess let me say, what would I mean by that? If you have historically been 5% of the losses of the pool, maybe in an individual year you had no losses, but other years you were 10% of the losses, we would expect a fair rating system that over that same time period, you would have been 5% of the contributions. Contribution level would have been stable, the loss level would have been unstable, but you would have had roughly that same approximation, right? If you're 10% of the losses over time, you probably should have been 10% of the premium. So again, that's getting into the rating systems, and let's kind of talk about that briefly and some of the concepts there. So the rating process, you generally have some sort of rating units. Pools, rating systems are fairly simplistic. You would generally, you're kind of basically doing an allocation based on payroll, values, your insured values. If you have more buildings, you're going to pay more for the property coverage than if you have less buildings, right? Number of vehicles, same concepts, FTEs, and what you're looking for here in the rating system is some sort of something that's going to correlate with losses. And again, these pool systems tend to be fairly on the simplistic side relative to the private industry, and that's because they can be. They have homogeneity in their membership often. So if you compare like your pool rating system with calling one of these auto carriers, you see all the commercials for, they're going to ask you a ton of questions, and they're looking at a lot of different variables and a very multivariate approach to analyzing that. But pools can kind of get by with more simplistic. So you got your rating units, you have your rates. That's going to be, based on your budgeted amount you want to collect. You translate that to rates, and the complexity varies. Can be very simple. Here's a rate per payroll. It just gets applied across the board. And you could have specific rates for different risk elements like workers' comp. On pools, you'll have different rates for your different class codes because those different class codes exhibit a different amount of loss propensity. And so in order to be fair, you would want different rates. You can also have tiered rating, meaning you would pay maybe there's a certain rate for the first $1 million in payroll, and then it's maybe a lower rate for the second kind of a tier. And we've seen some pools move to that as they get more sophisticated over time. But that's, these are how the contributions and the premiums are determined for the pool. Periodically, you want to review, how you're doing this. And this periodically doesn't mean every year. It can be very disruptive because, again, the rating system's a touch point. And if you change the rating system, some people pay more, some people pay less. That can be disruptive. But things do change over time. And you want to probably revisit periodically how you're doing it. You can almost think of it like a tax, right? So the example would be your estate and you need to collect money to pay for the roads. So, oh, I have a good idea. Let's go gas tax. And, the heavier vehicles use more gas, more wear and tear on the roads. Those that drive more should be probably paying more to maintain the roads. So this is a kind of a good way to do it. But what about electric cars? Now, all of a sudden you got to, maybe, well, the electric cars are heavier and maybe you need to, not saying what you should do, but there, you have to periodically kind of rethink, is this still working as intended? Are the facts and circumstances still as they are? And then also on this, pools, the rating systems were developed and they had very minimal data. They actually have a lot of data now. They've been around 20, 30, 40 years, some of them. And so to actually calibrate what the rates should be in the various tiers, you have that ability where you really didn't have the ability when maybe your initial rating system was developed. All right. Experience rating. That's one of often the favorite topics of pools, a lot of stuff. And we want to kind of delve into that and more again, on the concept level. So I'm an actuary, and part of being an actuary is you have to take a series of exams, and the exams would have different subjects. So one of the subjects was rate making. Here's the rate making exam. And the way it works is different people have written different papers on different rate making theories, and then you study those papers and you get tested on it, and hopefully you pass. And I still remember, way back when I was taking the exams, and there was a paper on experience rating. And I thought it was well done. I think it was probably written way back in the 60s, but it's, the classic actuarial question is, are drivers that have had one accident more likely to get in a new accident compared to drivers with no accidents? So you could take, the universe of all the drivers we have out there, who's had an accident, who hasn't, and then you look at the data for the next year and say, okay, well, what was the accident rate for those that have had accidents? What's the accident rates for those that have never had an accident? And if there was no difference, that's basically an argument. Well, what, past accidents are really not predictive of future accidents, so it probably shouldn't be a key rating variable. But maybe if those with an accidents are 10% more likely to get in a new accident, then maybe those with an accident should be paying 10% more. There's some predictive value in that. That's the actual concept. It's all about predictive value. If you have sufficient data, you can actually go and actually measure that. And that can be somewhat of a challenge for pools. Insurance companies get around this. They submit all their data to these things called rating bureaus. And so they have these voluminous data sets, and they can kind of, slice and dice and kind of really parameterize these kind of things. But pools often, I think, for both incentives and intuitive appeal, they want to be able to say their experience rated is just makes sound practice. I think it's very intuitive, right? Okay, those that are having more losses should probably pay more. Now, the issue though becomes, and we see this quite a bit with pools, is, let's just step back and think, well, why do we have pools? Well, pools were formed to address volatile claims experience, right? The member doesn't want the uncertainty of whatever their claims may be or may not be year to year. They would rather get certainty by paying a contribution to a pool or buying insurance, right? They want that budget stability. So with experience rating, what you've done is you're introducing the claims that are volatile by definition into the rating process. So if it's not done correctly, you can, what we call is an own goal, meaning the members want stability, And then in the zest to make sure everything's fair, you hold everybody accountable for their claims, which defeats the purpose of, why the pool was formed. So we can't get into too many details here. The recommendation is really work with your actuary to avoid the own goal. If you do an experience rating, don't lose sight of that initial, what's the actual predictive value? Make sure you have the right, limits in place to make sure you're not doing an own goal. And, basically the member has to go form a pool to pay for the volatility they're getting on their experience modification factors, which is kind of not a good situation. If you're not, priced right, or you haven't allocated your costs right in a pool, there's some issues. One is just a basic governance. Are you really treating your members fairly? You want to treat your members fairly, and you want to make sure, again, periodically have your rating system reviewed to make sure that that's happening. You've kind of thought of new issues that may have emerged, and if you're not doing it fairly, that leads to what we call adverse selection. You have some members that are paying more than they should, some members that are paying less than they should. Those members that are paying more are gonna, over time, be able to find cheaper options. And then you're left with the members, probably the worst members that should be paying more. And so that's really no good for everybody. Just, make sure everybody's treated fairly, and that you're not doing any, you're pulled a long-term favor by doing that. And then the other concept, a little more detailed, and it's more kind of a governance thing. It's kind of get a reallocation of public funds, right? So you're a risk sharing or organization. Various entities are, sending their money, and then you're paying the claims. You don't want a situation where you're starting to play legislature, meaning what I mean by that is, those library funds, the state didn't give them a lot of money. They're really hurting. And so we really need to really be sensitive to the rates for our library fund members. But our water districts, they have a lot of funding, and so we can maybe charge them more. If you do that, you're kind of out of your league. You're really reallocating, you're using this insurance mechanism to reallocate public funds, which is probably not the role. And them saying this, we've actually seen this come up in a few situations where the state attorney generals are actually looking at some polls saying, is this really, are they kind of getting more into the legislative function and using the pool as a backdoor way to reallocate public funds. Right. Another topic for actuaries would be capital adequacy. And so again, we have our balance sheet, assets, liabilities, and the net position. And then the capital adequacy question is really gets focused on the adequacy of this net position. How much is enough? What is the resiliency of your pool to withstand some of this estimate variation that's inherent in this process? Is this rain? You can think of it as your rainy day fund. Is it enough? Is it too much? Is it not enough? And again, financial statements are based on budgets, or financial statements and budgets are based on estimates, and the actual amount is going to vary. That's just a fact. It's going to vary. And how's that variation absorbed? Well, it's absorbed through your rainy day fund. Okay. Now, this is I think a challenge. I think this topic for a lot of pools, and for a couple of very logical reasons. So pools started in a financial crisis for public entities. People, they didn't have insurance, and it was more important to get a vehicle up and running and that was the immediate goal. It was, we need financial shelter. Oh, we got enabling legislation. Oh, we can form a pool. Nobody is thinking in the late 80s that these things are going to be around for 30, 40 years indefinitely. The concept of having proper capitalization to withstand all the various things that are going to happen to us was not on the horizon. It was more like, the storm came in, we have all these people, they don't have any homes, let's set up a bunch of tents. But those tents really aren't there for the long-term viability and keeping proper shelter for everybody through all the various seasons and things like that. So over time, pools, they started accumulating these rainy day funds, and they would, okay, well, how do we measure it? And at this timing, talking more like the 90s or so, 2000s, there actually wasn't a lot of good metrics out there in the broader insurance industry. And so pools were doing some things they would call, here's some benchmark ratios. Here's, we use the confidence level. These are kind of some things you'll hear around pooling. And a lot of that, it made sense at the time, given what's available, but the broader industry has advanced, and there's a much more sophisticated techniques now. And there's actually an actuarial standard that applies to pools and basically says, hey, if you're going to test the resiliency or the capital adequacy of a pool, you need to have this more robust process. And you can't just look at somebody else's risk and say, oh, this is how much money they have set aside for their savings. So that should be enough for my savings for retirement. No, because people's circumstances are different. Pool's circumstances are different. And you need to kind of look at your individual pool, what coverages are you offering? What are your retentions? What's your size? All those things. And key risk drivers are, the things that are driving the need for capital. Well, one is called reserving risk. Here I am calling it reserving risk. It's really unpaid claim risk, but it's commonly called reserving risk in the industry. Actuary made an estimate of unpaid claims. Actual cost of unpaid claims may be more. Where would that additional money come from? That would be a capital event. Underwriting risk refers to the uncertainty of pricing. You budgeted a certain loss level for the next year, the actual losses could come in different. And that would be another capital event. Asset credit risk means asset risk would be like your investments. Maybe you're in the stock market a little bit. The stock market goes up, it goes down. If it goes down, that reduces your capital. Credit risk would be often you bought reinsurance. So you bought a policy to cover all your catastrophic claims. Even A-rated carriers go insolvent. And maybe if they go insolvent, that obligation comes back to you. So you need to that has to be factored in to your capital. And operational risk, generally pretty small for a property casualty pool. It can be fairly significant for a health trust. If you get like some sort of HIPAA violation, you get some sort of fine, those fines can really, really multiply. But these are the various risk drivers. You can kind of think of it like an ERM kind of approach, enterprise risk management. What are all our various, you go through a risk register, and these are kind of a summation of the financial risks you would get out of that risk register. And these are the things you need to measure. And then how that actually works then is high level, the actuary comes in and measures the financial risks, those 4 categories. And it's a little bit different, though, than the other work the actuary does, because part of developing your capital assessment is you have to consider the risk tolerance of the organization. And so that's where the pool board and management need to kind of really think about their organization. And, the best way to, I think, explain it, if you plan your pool to be around for, 50, 100 years indefinitely, it's just a matter of time before you have that 1 in 100-year financial storm hit you. And you need to you need to have enough capital to withstand that. And that's kind of the mentality. And that's why insurance is so regulated, right? What are insurers giving you? A promise. Well, they have these rating agencies looking at their capital to make sure they have sufficient resources to fulfill those promises, and they give them a rating accordingly. And now those same concepts, you may not be regulated, you may not have a formal rating, but those same concepts can be used looking at your financial risk, what's the risk tolerance of your pool, to form what a risk capital target would be, kind of your sweet zone for what you want your capital to be. And maybe it needs to be sufficient, but you also don't want it to be excessive, because you're really tying up public resources. So this output of that process is shown on the right. So what we have here, the line represents the net position going back, quite a few years, just tracking that over time, right? Every year, here's our assets, here's our liabilities. We got this financial statement, and we're just mapping out what that net position is. And then we show a dotted line going out into the future. So the actuaries kind of said, hey, you guys don't want to take any rate action. Well, the amount of money you're collecting is pretty much in line with what the program's costing. So with no rate action, you're pretty much in line to kind of flatline your net position growth. You're not going to really, we're not expecting you to lose any, we're not expecting you to grow. Well, is that good or bad? Is that, is that helping us, or what does that mean for us as an organization? Now you can superimpose this red, yellow, green backdrop on it, and it means what you think it means: red, yellow, green. So red is regulatory minimum. So some pools are regulated, and so the state or who's ever regulating you would say, hey, at a minimum, you need a certain level of capital, or we're going to get involved. And so you want to avoid that. Okay, that's good. This pool's, well away from that red. But the regulator perspective is not how much capital you need for the long term. It's more, I want some money to deal with as I liquidate this organization that didn't know what they were doing. That's their perspective. It's not, so you need to have enough money to withstand the various storms you're going to be faced with in the future. That's represented, this risk capital target is this green zone. And the green zone's going up. Well, why is it going up? It very well could be the pool is getting bigger. Maybe it's the pool is taking on higher retentions. We talked about, if you're going to retain the first $500,000 of losses versus the first 250,000 of losses, you're going to have more volatility. Because the volatility, if you cap claims at $500,000, is going to be greater than if you cap them at 250,000. And that additional volatility means more financial risk, same risk tolerance. You're going to end up with a higher target. So that's something this pool's going to have to kind of come to terms with in order to kind of maintain their capital adequacy. They're going to have to figure out a way to either reduce the growth of their capital targets, or they're going to have to raise their capital. So covered a lot of things, and just kind of summarize, one of the big touch point with the members, and the big issue, okay, our annual rate level decision, right? What do we want to do with rates? And nobody wants double-digit rate increases. You want to keep those pretty steady, and a lot of actuarial input, and we're just going to kind of go over the actuarial input, and I think understanding these key concepts is critical for informed decision making. I'm not a fan of the actuary setting rates for people. I'm a fan of the actuary giving information so they can make good information, because there's some information you have and you bring to the table that the actuary isn't really privy to, and that's valid. So we talked about this, okay, projected losses. Well, where's that coming from? That's coming from the actuary. We talked about how that's done. Capital adequacy, we just went over that. That's an important thing. If you're very well capitalized and maybe you're exceeding your capital targets, you have a lot more flexibility in your rates, or vice versa. Competition, that's valid. It should be the sole consideration, but it's a valid if there's other options for your members. You need to be sensitive to that and consider that in some fashion. Rate stability, even if the projected costs have gone down, you may not want to follow that up with a rate decrease, because you may just have to reverse that later, and that could cause a lot of disruption to the members. And then the member funding situation, is it some funding from public entities can go in cycles, and maybe it's not a good year to raise rates. Maybe they'd rather draw a little from their capital account if it's sufficient. Other years it may be the opposite, and say, what, wait, it's a good year. We have great funding. We got this excess COVID money. If you're going to give us a rate increase, this is the year to do it. And then lastly, prospective risk profile. So what we mean by that is you have a certain kind of structure, right? You have a certain number of members, you have a certain kind of retention, your deductible. Talk to your broker and think about how sustainable is our current structure in the future. And you may want, if it's just a matter of time before your capital requirements goes up, you're going to need to increase your capital for that. So next topic, common issues here. Number one is just call it unrealistic expectations. So what you get from an actuary is these precise point estimates that go in the budget, they go in the financial statements, and the reality is you can't book a range. There's a range of outcomes and you really can't book that, right? You can't charge a range, you charge a number. And I think that precise estimates can lead to a perception that this business is more precise than it really is. Um, you'll hear that, oh, the actual estimate was wrong. Well, that's a statement, it's an estimate. It's not going to be right. That's why you're making the estimate. And so you can almost think of what it actually does as the dice, right? The actuary looks at the dice and we can quantify and tell you what it's going to be on average. Oh, it's going to be on average 7, and we can tell you what the variation is going to be. We cannot tell you in advance what it's going to be. I could study the dice for 100 years and we're still going to have that same variation. The fact that I estimated on average it's going to be 7 and it comes out 12 doesn't mean it was a bad estimate. It just means there was variation. And then another challenge, it's the same kind of concept of this false sense of comfort that just it's kind of creeps its way into the board meetings. Oh, the auditor came in. Oh, there's no audit exception. So the board member thinks that they're doing great financially. No, it just means you're accounting for things properly. That's good. You want to do that, but it doesn't necessarily mean you're properly funded for the long term. We met the regulatory minimum. Well, minimums are pretty low thresholds. So that's not saying much. And so if you don't have those other long-term metrics in front of you, you may get this false sense of comfort. And then lastly, people, they look at their history, right? Though this has never happened to us, therefore this will never happen to us. And that's not how you really want to run one of these organizations. It's more, the talk to your actuary, they've seen a thing or two, as the commercial would say, and it may not have happened to you, but it probably has happened to someone else. So again, quantifying the risk, that's what the actuary is doing, does not eliminate the risk. The risk is still there. Another issue, inadequate actuarial scope and input in key decisions. So we have kind of these are things that are happening. Unpaid claim estimate. Those pools generally have that one under control. Not an issue. The external auditor will make sure you're having that. Actuaries giving you an unpaid claim estimate, you book it on your financials are done. Actuary gives you projected losses for budget. I would say most pools rely on an actuary for that. And maybe, hopefully, the actuary is giving you a capital adequacy assessment. That's key as a board member to understand, well, what is the financial health of this thing I have financial oversight for? Still remains a little bit of gap in the industry, but it's still, I think it's getting better over time. These are just information items, though. The key decisions of pool that are really going to shape its influence its cash flows and shape its future is really that rate level decision and the reinsurance decision. Are you buying sufficient reinsurance, but are you buying it efficiently? So on the rate level decision, the actuary can really lay out what are the financial implications of these various rate actions. Just like I said, you can keep the stable rates. You're not going to grow the fund balance, but that has some implications because the risk of the pool was growing on that prior slide we looked at. These are things the actuaries can kind of help tie all these concepts together. And then the reinsurance, right? If prices go up, you should probably be reevaluating, whether you should be buying, right? It's really expensive to go out to eat. So maybe we don't want to go out to eat as much, right? Maybe we should eat at home. The same concept as the reinsurance gets more expensive with this hard market. Maybe it made sense to buy that $100,000 retention when it was cheap. Maybe it doesn't make sense now. And your purchase of reinsurance is directly tied to the capital adequacy, and the actuary can frame up for the board and the management what the pros and cons of different options are. So point being, you want your actuary not just giving you a couple data points that then you're going to kind of assemble on, but help work with them to kind of frame it out and see what that decision is. So again, those are the key decisions. It's not enough just to say, oh, we got the estimate of unpaid claims, or we have the estimate of projections. The key decision again is, well, how much money are you bringing in, and how much risk are you retaining with that reinsurance? That's what's you're gonna look back later and have regrets about if something were to happen. Last issue we see, game of telephone. So that's, if you remember that when some of us were kids, you have the kids would line up, you give them a phrase, and they repeat the phrase whisper it to the person on the right, and you go through a sequence, and then you compare what was the initial phrase with what comes out, and it was always kind of comical. Sometimes there was no resemblance, sometimes it would just change. And the actuarial estimates drive the financial outcomes, and the actuary is the one of anybody who's going to really understand the key risk drivers of those estimates and the things that can happen. And you really want to be hearing directly from the actuary. You don't want to have a situation where it's paraphrased. So this is what happened. The actuary says, I project losses to be 10 million. There's a lot of uncertainties out there in this most recent year. We saw a lot of claims develop in this coverage. We're really not sure what's going on with that, and something to be mindful of. Then you read the board package that somebody else put together. The actuary said our losses next year will be 10 million. No, there's a whole lost in translation there. So you want to have that direct communication and avoid something being paraphrased and then paraphrased and oversimplified and whatnot, because it is these concepts and these estimates are important. Last section, working more effectively with the actuary. Let's just kind of go through, a typical pool budget line by line. Well, the contribution you're collecting, well, the actuary can again help you. There's financial impacts of various rate options. They can help you measure that. What's the short term? Is it viable, this rate you want? Maybe it's viable in the short term, it's not viable in the long term. They can help frame that up for you. And really, so you're making the decision. Maybe it makes sense to kick the can, take the rate increase next year. Maybe it doesn't. But the actuary of anybody is going to be able to frame that up. Investment income, we didn't really go over that too much, but the investment, there's volatility with a more aggressive investment portfolio. And interest rates move, stock market goes up and down. That's one of the capital needs. And so if you're going to be relying on investment income to fund the program, the actuary would have a perspective on that as well. Clearly on your expenses, retained losses, the actuary, is giving you that projection. They can help with that. Reinsurance is getting to be a bigger and bigger purchase. Well, is it really cost effective? Is it better to retain some of this risk versus transferring? Again, the actuary is the one that's going to be able to kind of frame up that decision. Administrative budget, typically not a big cost item, but the actuary can kind of give you a perspective of, hey, here's your typical expense ratio that's out there. Here's how your expense ratio compares. It's typically very, very good for pools. And then lastly, if the margin, should you be, depending on your capital adequacy, you may want to be collecting more or less, and the actuary can help frame that up in order to meet your long-term goals. So again, all over the financials, there's actuarial input, and it's important to have kind of a rough idea of these concepts. Common questions, you sit there, you give your presentation, and it's really key to ask questions. It really helps the actuary, if you've ever been a teacher and you're talking to a class and everybody just sits there, you're like, oh, do they understand? Or do they completely understand in their board, or am I just talking over their heads? And so a question is really, really key. And the best questions always come from the new board members, because they don't know anything and they don't have any expectations. So and the actuary needs to understand your perspective. They need to understand what level you understand things at, and then that can make them a better communicator. And they also need to understand your concerns. If your concern is rate stability, then they need to kind of design a rating structure around that. So, here's some examples, right? What trends are you seeing? We talked about the way the actuary organizes losses. Their perspective of the trends may be very different than what the claim staff is seeing. It's just that more formal way of organizing it. So the actuary will have good insight on that. If you have a rate decision, ask the actuary what they would do. How do they frame up? How do they say, I just had that yesterday. Hey, what would you do, Kevin, if you were us? I said, well, okay, well, there's a risk we're not collecting enough. There's a risk we're collecting too much. And we're trying to balance those two risks, and we don't know what the future is going to hold, but we thought this, was a good balance. And okay, yeah, that made sense to them. Are we adequately capitalized? That's a loaded question because of the actuarial standards. The actuary there's a certain robustness in the answer that they would need to do. Are the current scope of services sufficient? So what we mean, you hire an actuary, you have a scope of services. Um, hopefully not, but what if that's the same scope of services for the last 30 years? It's what was necessary 30 years ago may not be necessary for a pool that's trying to kind of survive for the long term. And just like you have a contract to do your house, right? Okay, well, what other work do you think needs to be done based on your expertise? Ask the actuary that. What are you doing for other pools that we're not having you do? Just to kind of take advantage of their expertise when you're talking to them. And we talked about evaluating reinsurance options. What would they do? What's the pros and cons of that? And then one of the best questions I had recently, the board member, hey, they were faced with a huge rate increase, and can you guarantee we will be okay financially if we adopt this large rate increase? And of course, we don't guarantee anything, but it led that understanding his frame of reference. He wanted certainty in this uncertain business, and it really led to a good discussion of what we know and what we don't know, what can be guaranteed, what can't be guaranteed, and it really was an education. So be professional, but be direct. Don't, actuaries generally have pretty thick skins. There's no expectation. You're an insurance expert. So there's nearly no such thing as a dumb question. And again, it's important that the actuary understand kind of your perspective and what your priorities are on the program. So again, this is again to understand the key concepts, not the details. One of the things we didn't talk about too much, but just want to call it out, is actuarial reports. They are gory details. The actuary has a professional obligation to detail out their calculations so another actuary could understand how they came to their conclusions. Don't let those thick reports with all the schedules intimidate you. They're not really written for you. They're written for a professional obligation, and it really, tombstones, what were the estimates based on? Instead, focus on the executive summary and, gaining insights. There should be some understanding of how the losses are trending. Secondly, you're in the risk and uncertainty business. That's probably different than your normal business. What do they say? And, insurance companies, pools, and casinos voluntarily take risk. And you have to have kind of a different mindset. Don't be afraid of the risk, but you just have to manage it and understand what's the range of outcomes, because that's much more important than just the simple, here's the midpoint estimates the actuary is giving us. And lastly, long-term financial viability. You were formed as a temporary agency, most likely to handle a temporary crisis. Long-term viability requires really thinking about these things, understanding, what decisions are we making? What are the financial implications? And you got to make good risk and capital decisions. And so you're going to be there for the long term for your membership. So appreciate everybody attending, and hope to see you at the next A Group conference.